making an investment in that sector successful is hugely important. So,
okay, next question. How do you guys, looking out to 2010, 2011, we basically said that rent rolls aren't going anywhere, if not going down. How are you underwriting it? You guys are all probably managing $5 billion across the board. Plus, how do you underwrite deals going forward?
Yeah, I mean, again, I guess this goes back to, like Tim said before, it's pretty market specific because certain markets are going to do better than others. But I think as a average, we probably are using 2010 with zero growth on the income. And whereas in 2009, we probably had an average of negative 2% when we were starting to underwrite deals for this year. I think we then gradually grow our rents, probably starting in 2011, we'll see some growth. And then we believe 2012, 2013, we should see a pop. And, you know, it's hard to model a 5 or 6 or 7% growth rate. But we do believe in a lot of these markets and a lot of the research that we see that by 2012, 2013, we'll probably be above our average 3 that we used to throw in when we were using growth rates.
Yeah, I kind of second that. I mean, generally, when we're underwriting, we hold rents. We take rents today, which we think are pretty beat up, hold them flat for generally 2 years, and then we start growing them at inflation, whatever that might be, right? Which we generally think is 3%. However, you know, you have to layer that onto the issues that everybody here is dealing with, which is, you know, the monetary supply, the amount of money that's out there, the fact that everybody thinks inflation is coming, and that interest rates are going to be going up. So at some point, you know, if you're modeling out inflationary growth in your rents and you're using a 3% number, you're probably going to be grossly wrong. But at the same time, the last thing you want to do is go before your limited investors or your investment committee and say, hey, you know, I think rents are going to grow 8% in 2014. I mean, that'll be a very short conversation. So probably underestimating growth, quite frankly.
We might have a slightly different view on that. You know, we're a lot more concerned about if and when growth picks up again on the income side, on the rent side. You know, with unemployment where it is, headed north, and the projections of the time in which it's going to take to work that down, grind that down. You know, there are a lot of people who say we're in for a Japan-style decade with very little inflation or no inflation. And you know, if you couple that with very high unemployment, you know, the concern that we have is, gee, are you going to be able to maintain your rent roll this year, next year, the following year? And so, you know, if you have that point of view, it says a lot about how you're underwriting the new buy. And our concern is that could we be headed into another sort of bubble-type situation in the way that these assets are priced, if in fact your rent roll continues to decline? That's the concern. You know, that's the debate for us.
Well, we like apartment sector because you can lever up, right? Positive leverage. This is about the only sector left. You know, you can do high leverage, 70% LTV, 75%, stuff like that. On the other hand, we do feel the cautiousness, and because the Federal Reserve, we look at the balance sheet, $2 trillion. 1/3 of those actually they purchase the GSE debt. So for that reason, makes the GSE financing so attractive. So now everybody talking about the exit strategy, what they're going to do, when they're going to stop purchasing GSE debt. When that happens, so the GSE financing cost could go up. So your new purchase could have write-down right away, between 10 to 20%, anywhere you can imagine. So we try to be selective, we try to be cautious, and using dollar cost average, not deploy all money at the same time. Try to do it gradually, see how the situation develops.
Max, what kind of debt are you seeing right now? What kind of debt are your clients wanting to put on the deals?
Yeah, I was going to add to Mark and sort of get to that. You know, as Mark said, I think we're underwriting basically no rent increases over the next year or two, as are most lenders. But I think the reason that deals are working, and this goes back to your question, you know, is because you can get debt today, 70, 75% leverage on multifamily properties at 5.5, 6%. and as Tim said, create positive leverage and day one cash on cash returns. So I think the focus needs to be on the in-place income today, and understand that that's most likely not going to increase over the next year, 2, maybe 3 years, but that as an experienced owner with debt, with the debt that's out there, you can create positive leverage and make a deal work fairly well in terms of returns, even though there's not going to be rent growth moving forward, mainly because of the capital that's out there right now.
Okay, any other questions right now? Sir?
Do you gentlemen take into account the eviction laws for the specific state in which you're thinking about acquiring a property? The reason I ask is, as opposed to New York, to evict a tenant, it could take 6 to 12 months versus Pennsylvania, which could take 30 days. Obviously, you can see how that could affect rent rolls and increase the vacancy rates.
Gentlemen?
Yeah, we do, and not necessarily on a state-by-state basis, and generally, our business plans aren't predicated on evicting tenants. Tenants pay your rent, so that keeps your cash flow going. But it is something that you keep in mind. I mean, we own properties throughout all the boroughs, 4 out of the 5 boroughs in New York, and each borough has its own court system that you have to deal with. The Bronx is notoriously difficult. So it's something you keep in the back of your mind. It's not something that we particularly identify when we're looking at an acquisition.
Yeah, it just, for us, it underscores an important part of how we do our investing. We typically invest with a local operating partner and somebody who's an expert in whether it's a state or a region. We are absolutely taking a look at issues like that, but we internally don't have the resources to understand each market, and the day-to-day for eviction. So we would rely on an operating partner to do that. The nice part about this environment is that many of the capital sources that were funding operating partners have exited the market, and so there's an opportunity to build new relationships with new operating partners in new markets for us, which is very attractive at the moment.
I've got a question for you guys, and then we'll get back to that next question for you guys. We all believe rent rolls are flat, if not down, across the country versus DC and stuff like that. Is anybody selling next year? Are any of you guys selling? Is anybody in the audience selling?
Well, I'll start. Luckily, well, not luckily, but most of the stuff that we bought was bought in 05, 06, 07, so we do have long-term debt. I think we'll sell one deal, and that's going to be the one that has the refinance issue. I think it's going to be our best strategy because of the frothiness with the core and being able to get out of it and pay off the debt and return some equity. But for the most part, all of our stuff was bought in the last 3 to 4 years. We have long-term debt, so we really have no motivation to sell today unless it was a core asset that someone was going to overpay for, and it's just not going to happen. We bought them at low cap rates, 05, 06, 07, so there's no way we could get out of it today and make any money, let alone we probably lose some equity. So we have no motivation today to sell. We believe that in 2 to 3 years, because of the lack of construction starts today and because of the demographics, that the operations will improve in a few years and that we will be able to sell at that time and make some money.
General. Anybody?
As I mentioned earlier, we have a Gables apartment platform in the south, so we do a lot of development. So one of the strategies is to build, lease up, and sell. So 2010, we will be selling. We want to take advantage of the market dynamic, try to adjust our portfolio, reposition in some of the market. We probably will be selling in Texas, a little bit in Miami, and repositioning somewhere else.
Different question. Or?
No.
Okay, and for any of you guys, we all know that the C, D, whatever you want to call it, assets are hurting. Cash flow is hurting. TRAP just came out. 90 days and worse is 6.4% of all CMBS loans. Who buys this stuff? Okay? Who buys it? Looking out, we all know it's coming. All the brokers, I mean, Gary's guys across the country have this stuff.